Yeah, now, Raul, I've interviewed your friend and business partner, Grant Williams, a number of times in the past, but he talks about your theory of a strong dollar doing damage. What type of damage can a strong US dollar relative to other currencies do to the global economy?
Yes, yes, strong dollar is a weird thing because many people wish for it without realizing what it does. The problem is there's so many people who borrow dollars. I think the BIS claimed there's maybe $10 trillion that have been borrowed by foreigners. It means that if the dollar goes up, then your liability, what you need to pay back, goes up too. So it creates a huge problem and a shortage of dollars out in the system. And that's very prevalent out in the market today. I mean, the dollar has been trading sideways for a while now, but over the last few years, it's been very strong. And what that does, it means that things like oil prices also fall in value because they're denominated in dollars. So foreign countries receive less dollars. Now, there's already a shortage of dollars because of the dollar funding issue I just talked about. So suddenly there's a mad scramble for dollars, and people are reporting less and less profits in dollar terms. Now, that's important because dollars are what makes the world go round. Most trade is done in dollars. So if you're making less dollar revenues, you can afford to buy less things in dollars. So what it happens is it crimps world trade significantly. And that was what we saw last year and the year before, was world trade shrinking dramatically because of what was going on with the dollar. So that's why it's a big problem. It also causes big problems to emerging markets generally again, because they have dollar liabilities and emerging market earnings. So again, they can't pay for their liabilities. So those kind of things create a big problem.
Yeah, that's a great point. We saw emerging market currencies like Russia and Brazil just have enormous currency drops in the last couple of years, over 30%. And not only did their own currencies fall and commodity prices fell, which is what those economies are based on, we also saw that their debt was due back in US dollars, which were strengthening. So it seemed like a double whammy, even a triple whammy if you factor in the commodity prices going lower as well.
Exactly right. Exactly right. And that was the story of the last 2 years. This year has been much more stable. That's why we've seen things ease off, the markets ease higher as some of that pressure has been taken off. But it's not to say that it's gone away. If I look at previous dollar bull markets, there's only been two in history since the dollar freely floated. The first one was in the early 80s. It rose around 100% using the DXY, which is the dollar index. Back in the late 90s was the other dollar bull market. It rose about 50%. So far, it's risen about 35% and then kind of paused around these levels. The last two dollar bull markets also pause around this 35% level before moving much higher. And I still think that's the most likely case now. So we're in a pause phase before it moves higher.
Do you think the dollar index and what it says guides the Federal Reserve's thinking about what to do with monetary policy?
Yes, of course it will do, because don't forget, as the dollar rises, then the cost of imports falls, so it's deflationary. So, of course, it does do that. Also, they note, and they have noted in their minutes, that world growth has slowed, and that was also because of the dollar. Now, the question is whether the Fed can do much about a strong dollar, because interest rates are incredibly low. And yes, I mean, it's a problem right now because I guess 10-year bonds are at 1.5%, while European bonds are negative and UK bonds are almost at zero and Japanese bonds are negative. So it sucks money into the US, and the Fed will have to lower interest rates much further over time if they want to stop the dollar rising because of the relative attractiveness of US rates.
I thought, Raul, that long term, no central banker, especially most of them because they're all Keynesians, they don't want a strong currency. So they may go out in public on TV and say, oh, we have a strong dollar policy. That's what the U.S. has said in the past with Robert Rubin as Treasury Secretary. But, their actions said basically otherwise. Your friend and co-founder of Real Vision TV, Grant Williams, has said in past interviews on my show that he thinks central bankers are trapped. Do you agree with him?
I don't think they're trapped yet, but they are getting into the trap. I mean, well, the US is not trapped yet. I mean, Europe is certainly down in the trap now with negative rates. Where else is there to go? More negative? Of course, it's possible. More fiscal stimulus backed by QE? That's possible too. The US has some way to go before its rates equalize with the rest of the world. So I don't think the Federal Reserve is trapped yet, but I do expect rates to fall further quickly.
Now, do you expect central bank balance sheets to actually decrease anytime soon, or do you think they're going to increase?
That'd be ridiculous. They got no chance of reducing their balance sheet. So in the next recession, they will increase them. They have no choice. And that's the problem. Is it's not the ordinary course of events in this kind of sluggish growth environment that's the problem. It's always the next recession. When the next recession comes, then central banks have to take more and more extreme measures. I mean, these extreme measures that we've seen now were started in the previous recession. They're still ongoing. So what do they have to do in the next recession? And the question is then is, do they lose control of it? And, that's a question none of us know yet. Is it this time around or next time around? But we know at some point it's most likely to come.
Do you think any of the problems that caused the 2008 crisis, do you think the central banks and politicians have solved really any of them?
No. No, the financialization of the global economy is still a problem. It is shrinking over time, but it's still gigantic. I mean, only just to have the number $10 trillion borrowed in US dollars, you can see the size of it. It's everywhere, and it's an epidemic. I mean, it's in China, it's in Asia, it's in South America, it's all over the world. So we've not got rid of that core issue, which is debt. And all we've tried to do is paper over the cracks by elevating asset prices or hiding kind of the market price signaling mechanisms.
Yeah, I agree with that. Now, I think according to Zero Hedge, there's over 180 billion per month now in central banks doing global quantitative easing or some type of liquidity programs. It looks to me like this is causing enormous amount of asset price inflation at almost all costs. Do you think there's asset bubbles almost everywhere now?
Yes, I do. I mean, I think some of them perpetuate longer. So I think bond yields fall significantly further still before we get to that end point we just talked about. I think we're a way away from that yet. Somebody's going to make a mistake at some point. We don't know where that's coming from or what that looks like. But I think we'd have to see significantly weaker currencies elsewhere for us to see an inflationary pressure build or something problematic within the major economies. So, yes, I mean, there are certainly bubbles still left in equity markets. There's a building bubble in the commercial real estate market and REITs, dividend paying stocks. There's bubbles in private equity. Bubbles in venture capital. We've got a burst bubble in commodities now, and we've still got some way to go before we can unwind this ridiculous situation of too much money sloshing around into the wrong places, and that's been the policy that they've tried to pursue for some time now.
Switching gears, I want to ask you now about Brexit and the European banking crisis. Do you think Brexit has accelerated problems with European banks?
I think European banks have already fallen about 50% on the year before Brexit happened. I think Brexit at the margin is not good for anybody. I think the market wildly underestimates the importance of what went on. People like to say, oh, it's great because the UK get their kind of liberty back. Well, that's the kind of, the shorthand that people have on the take of it from the people in the financial market community. The reality is actually wildly different. The problem is things like intellectual property rights, banking regulations, all sorts of stuff, common agricultural policies, agricultural subsidies. A lot of the legal system is all wound up in Europe and the free trade agreements, and that all lot needs to be redone by the UK on their own. That's a huge issue. But does that change the banking system? Well, it just exposes more of the weaknesses to the underlying issues within Europe, and some of the bigger banks like Deutsche Bank, which are based predominantly in the UK for a lot of their international business, it makes it somewhat more difficult for them.
Yeah, it looks like the bureaucrats in Brussels still have a good solid 2 years to try with whatever policy measures and lawsuits and things like that to block Brexit anyway. So it's not completely done, all the hurdles that they have to overcome anyways.
No, that's right. But the interesting thing is the UK didn't figure out, because nobody expected it to happen. The UK didn't figure out that they now have to go into trade negotiations with everybody knowing, and trade negotiators are the hardest people on earth. These guys know that the UK needs to get deals done and quickly, so their best tactic is to delay it as long as possible. So it's actually difficult for the UK, and that's why one of the reasons the UK banks got hit, because obviously gilt yields have plummeted on the back of this as UK growth gets marked down, but also it's a very complicated situation on where UK is going to get its growth from when it has to go through all these trade negotiations.
Yeah, and the European bank stress test, I think that was done probably to try to shore confidence in the markets, maybe so the banks could raise some equity capital at a higher valuation and maybe stop the shorts in their tracks. But that seems to have not really worked. Do you think all these European banks, they're going to end up needing to be bailed out?
Yeah. Now, bailed out, bailed in, taken over by the government, I don't know which one. I don't think the Germans have the stomach of bailing in Deutsche Bank or the Swiss with Credit Suisse. So they're going to break the rules yet again that they set up for everybody else, which I think is somewhat unfair, but that's what's going to happen. So I think, in the end, maybe Deutsche Bank has to become owned by the by the German state. And I think Italy's got bigger problems to deal with because there's too many banks and they can't privatize or nationalize all of them. I think there's still problems, as I said, in the UK banking system, the Spanish banking system, which is not talked about by anybody. I mean, the share prices have been plummeting in those stocks as well. So that whole issue is still out there. It's not resolved, and I think it's only going to get worse.
Yeah, I agree. I think it's only going to get worse. Actually, that was a Freudian slip, I think you said earlier about Deutsche Bank being owned by the US, because I think ultimately the Federal Reserve's probably going to have to come in and bail out some of these European banks by giving currency swaps to the European Central Bank.
Yeah, exactly right. Because again, if you think about it, it's that shortage of dollars and all of these liabilities. I mean, Deutsche Bank with its ridiculous $70 trillion or whatever the number is of derivatives, a lot of them are netted off, but a lot of this is dollar-based exposure as well. So that's another place where this dollar shortfall is showing itself up.
Now, you were a successful hedge fund manager for a while. Did you ever dream that you would see large central banks like the Swiss National Bank owning $60 billion worth of stocks and the Bank of Japan going in and buying ETFs?
You know what? Most of us had always suspected the Federal Reserve used the stock market at various points, and whether that's been proven or not, I don't know. But so it wasn't a huge leap of faith to imagine it, because in Asia, the central banks had been buying equities over the last 20 years anyway. I mean, the BOJ have intervened in the equity markets, the Hong Kong had intervened in the equity markets, Korea had, Taiwan had. So it wasn't much of a stretch. I mean, much of the examples have already been set. So however extreme a lot of these central bank measures look now, if our role in the global macro investing is to live in the future. And to live in the future, much of this was predictable.
Yeah, I think it's predictable from Ben Bernanke's 2002 helicopter speech and some of the ridiculous stuff he said that wasn't actually covered by the mainstream media. But did you actually know that the Swiss Central Bank owns about $1 billion worth of gold and silver shares? I was actually surprised to learn that.
Well, they own all sorts of shares. I mean, their stake in Apple is ridiculous.
Well, they're hedging with gold and silver, though. I'm surprised considering, how most central bankers feel about gold and silver, that they were buying, Silver Wheaton and some of the good gold and silver companies.
Yeah, it's amazing.
Well, in terms of a solution to the global economy, do you think there's going to be some type of new global financial system in the next 10 or 15 years, or some type of global reset in the future then?
Well, I mean, the reality is we can all pontificate, but none of us know anything. This is so off the map that there are numerous outcomes that have reasonable probabilities. My best guess is that at some way, somehow down the line, there's going to have to be some debt jubilee. Again, that won't happen until a recession, when people are forced to, when the system is creaking yet again. Something like that has to happen. And what that means terribly is the savers are going to get killed and the debtors are going to make out like bandits because of it. But unfortunately, that's the way of the world. I don't see many ways around it. You can think about trying to inflate your way out over 20 years. The Japanese failed that. All they've done is increase their debt burden. Currency devaluations don't really do much about it either. So what do? I mean, somehow you either transfer it all to the central bank balance sheet and write it off. Now, don't forget that kills your pension system and various other things too, your insurance sector, life insurance sector. So it's really complicated how this has to play out. Nobody really knows any answers, but we do know that in the end, the amount of debt is unsustainable and it will have to disappear. And, there are various mechanisms that has happened in the past. And I guess it won't be any different to the past this time.
Yeah, it seems like a bunch of bad outcomes. I can't, I've listened to your interviews talk about probabilities. I mean, I can't guarantee any of them except that the politicians and central bankers are going to do stupid policy decisions and they are going to change the rules on us a lot, whether it's taxes on different asset classes or things like that. So I can't say anything for certain except that the people in power are going to change a lot of the rules on us going forward.
Exactly. And again, we don't even know the outcomes or the unintended consequences of those either. And this is how complicated financial markets is. One of the reasons we set up Real Vision Television is because things are so complex now, and the media let people down so badly in explaining what was going on that there was a real need for, a platform for people to be able to talk in depth about real financial issues and not, sound bites from the media, because this is super complicated. We don't know how it's going to play out, but we have to act with caution.
Exactly. And I actually wanted to transition and ask you now about the people that you've interviewed for Real Vision Television. You've gone all over the world and you've interviewed people I've dreamed of interviewing, like Kyle Bass, billionaire hedge fund managers. What do they think of the global economy, and what do they think could be some of the next crisis points?
You see, again, there's a lot of macro guys there, and a lot of them live in the future. So right now, they may be saying, that they're not. Nobody's really sure what's going on right now because there's a lot of converging things. Some indicators say one thing, some another, but most of them think, okay, a recession is overdue. It has to come. If it comes, what happens to rates? And they all think lower. Then what happens to countries like Japan where rates are very low already? That's the unknown. We don't really understand how that works. What happens to currency markets? I mean, I think people think about the US dollar. Many people think the US dollar will go up over time. And then there's a definite consensus that's been building about, okay, there's a lot of complicated things, a lot of things moving up and down. Different people have different bets on stuff like oil and stuff. But people realize that as you go towards the next recession, as rates fall further and we get more negative rates, then interestingly enough, there's now a consensus building about gold being the play for the next 5 years.
Yeah, I like gold and silver a lot. I think the paper bear market for gold and silver was over. We saw an enormous amount of physical demand for gold and silver markets from 2011 to present day, but that didn't translate to a higher paper metals price. I think, though, Raul, that we're going to see a lot of currency volatility going forward because the central bankers, they don't want to stop intervening in markets. In fact, I think we're only going to see even more interventions going forward into different types of markets and different monetary and fiscal policies.
Yeah. I totally agree. Totally agree. And it makes it very hard for people to understand how to invest or trade around this. It's just not easy. I mean, for everybody, all of the most experienced hedge fund managers in the world, this is completely new to them all, which is why so many people have kind of shutting up shop, giving up the game, or people are just saying, listen, get out of everything for the time being, because we really don't know what's going on here.
Yeah, it's very difficult if you're a value guy, fundamental analysis value investor, bottom up, even if you do top down then bottom up, it's tough to value things properly when you see the central banks coming in with, new liquidity injections over 180 billion per month globally now in quantitative easing. As a bottom up stock picker, it's going to be very difficult then to figure out what relative value is then.
Exactly right. And also with bond yields at, 500-year lows in many European countries. I mean, how do you value stocks when we were taught we have to value stocks off the bond yield? That doesn't make any sense anymore. It becomes really, really a complex game of trying to understand what's what. And a lot of it is just by following the flow of funds. The people investing in dividend stocks because they need yields, that kind of thing. I mean, that's one of the reasons REITs have been going up in a straight line is because, they're a pseudo bond for the pensions industry. Pensions industry basically is trying to get 7.5% returns. They've got no chance. And particularly in the bond market, so they start to look for commercial property, stuff like that, where you can get a 7% return. So they're piling into that, piling into REITs. It's really is a messy situation, I think.
Yeah, I agree. There's just so many potential collapse or trigger points or black swans, whatever you want to call it. I see so many black swans out there. I don't even see any white swans anymore.
Yeah, I mean, that is a problem that we're all facing, right? We need to be cautious not to get ourselves in a big pickle over how terrible things are and not realize that there is a journey to get to from here to there. We know where it's going, but that path from here to there is much less certain. So we need to be careful not to think, well, the world's going to shit in several years' time, therefore, we need to be short the S&P. Sometimes it doesn't work that way. And I think many people are struggling with that. I think we have to be very, very cautious in making assertions about what markets should be doing right now.
Yeah, I actually agree with you. If you go back through financial history and you study the Austrian School of Economics, you actually see that in past markets, whether it's Zimbabwe or Weimar Republic in Germany, that even when the real economy is crumbling, the asset markets, some of them, hyperinflated and went crazy higher and higher, and they totally defied expectations. So for the people that saying, the stocks have to, every single asset market has to crash because the real economy and the global economy are getting worse, history says the exact opposite, at least for a certain amount of time.
Well, that's only because they value them in currency terms. So if the value of that currency collapses in the global marketplace, then often the stock market adjusts. We've seen that in Venezuela, we've seen it in Iran, we've seen it in various countries that have had high inflation. We've seen it in Argentina. But overall, we have to bear in mind that US equity markets, particularly US equity markets, are the most one of the most overvalued in history, the second most overvalued of all time. And so therefore, the propensity for good returns going forward have to be diminished. So we have to realize that, it's not a great risk reward, but we are in a new world. We don't understand what negative rates mean for the equity market. We understand what it may mean for banks and pension funds and various others, but the equity market per se, we don't really know. I mean, there's companies all over the world now borrowing at negative rates. I mean, what does that mean? They can throw money at any project and lose in it, and it makes very little difference.
Yeah, Raul, the negative rates, it seems to me there's a couple reasons why that's being done. There's the wealth effect, which is trying to get people to buy asset prices higher so they have higher capital gains, and then they'll spend more money. That's, the Keynesian part of the Keynesian economics there of get into debt and spend. And the other part is the government's borrowing. With financial repression and negative interest rates, you look at the total amount of debt payments the U.S. has had 10 years ago, 15 years ago, when the interest rates were much higher. Their debt payments are smaller now with a larger total amount of principal on their debt than they were before at a higher interest rate because of financial repression.
Absolutely right. Absolutely right.
I want to ask you now about Bitcoin, since you do cover that. Do you think that's going to be very disruptive? How are some of your colleagues who are more sophisticated hedge fund managers, what do they think of Bitcoin in terms of its being able to being adopted by people on Main Street and the financial industry?
Bitcoin is probably the greatest technological advance or the greatest advance in financial market since the invention of derivatives. Derivatives were a great thing and then they weren't, but Bitcoin itself is a multifaceted thing. It is a currency, it's a means of exchange, it's an exchange platform, it's a method of recording transactions, it's a new way of accounting, and it has the potential to be the architecture for the entire financial system. It is a very, very good thing and needed in many of those terms because we need recorded ownership, because right now in the global system, we don't have recorded ownership of many things. Hence why big problems when things like Lehman go bust is trying to unwind who owns what, because basically the system is so levered that there's something like 35 claims on every 10-year bond because everybody uses the same bond as collateral. That's what the repo markets are about. So having Bitcoin, or particularly the blockchain, is a game changer for everything. But it has so many different uses that it seems like, and so many really, really important, smart people getting involved in it, that it just feels like its momentum is much bigger than anybody realizes. And it does feel like the early days of the internet, but this is the internet of finance.
Yeah, we keep seeing from the mainstream financial media every time there's a problem with one of the exchanges being hacked that, Bitcoin is dead. But I mean, I think they've written over 1,000 articles. Someone's keeping track of it. I think they've written over 1,000 articles since Bitcoin was created that Bitcoin is dead. So, I mean, it's just the technology that with the blockchain, I think I'm reading actually a new book about it now by Don Tapscott. It solves a lot of problems out there in the economy. Now, will everyone adopt it? I don't think so. I prefer gold and silver, but for a store of value, but I think, there will be a usage for it in the economy.
Yeah, look, it's not, forget the currency thing. So many people get a whole stew about, gold versus Bitcoin. They're not the same things, even vaguely. Bitcoin is a share of, it's the cost of a share of a part of the blockchain. And that's what it is. So it's not really a currency. You can use it as a currency because it has value. But it is not something to replace gold. It works alongside, but it's actually the foundation stone, as I said, for the new financial architecture.
Now, a lot of this interview has been kind of negative with a lot of the fundamentals in the global economy and talking about some news and bad policy decisions by politicians and central bankers. But I want to ask you about something positive. Where do you see any bull markets now in any markets in terms of technology or emerging markets for our listeners out there who are looking to do research for potential investments?
It's a somewhat complicated world, as we know, because there's so many things with the correlation of one. So it's very difficult to look for diversification. The greatest diversification on earth is a market that Americans can't trade but will be able to very soon, which is Iran. Iran is a population of 70 million highly educated people. I've spent some time in Iran, looked around. It is an incredible investment opportunity. It's like the world stopped and they kept the streets clean since 1980. And that switch is about to be turned on. And Iran's going to enter in the world stage in a way that people don't quite imagine. It is one of the biggest changes we'll have seen since China came back on the world stage. And Iran is the cheapest stock market I've almost ever seen. It's still currently on a P of about 5. It's not just an oil resource country because it's been cut off from global markets so long. It is a deep, diversified economy. It has deep trade links with all of its region. It's always been a regional superpower. So that's my biggest, if you had to do one thing, go to the beach for 10 years, I think you could just buy Iran. It will be available for Americans. Europeans can start investing in Iran already as sanctions have been lifted. So everything will change there. So I think that's probably the biggest opportunity. I still like Bitcoin as an opportunity going forwards. There's not many emerging markets I particularly like right now. They become very esoteric once you start to get to interesting ones, and they're probably too small or too difficult to trade. I think I'm still a big fan of the US dollar. I think the US dollar goes higher over time. So I think that's a relatively low risk reward trade. I also love the trade of having long dollars, long gold. Gold is denominated in dollars, so that seems a bit strange. But when you realize that there are two different things going on, one is negative rates that makes gold very attractive, and the fact that the US has more positive rates than almost anywhere else in the major economies, it's attracting capital, as we talked about before, from the shortage of dollars. So you can get a situation where both gold and dollars rises. And if I'm wrong, then one falls, one rises. You kind of negate it, so you don't lose a ton of money. If you get it right, you make out on both. So I think that's getting interesting. I think that goes for a period of time to come. I still think US bond trade, TLT, stuff like that, I think that's a good trade to go. I don't see any reason why the US 10-year should be at 1.5% and the UK 10-year should be at 0.54 or Germany at 0 right now. So I think that gap can be closed. I think things like TLT make that a very easy bet. So I think those are the most positive things. The other thing I'm really positive on is, in this day and age, with all asset markets pretty heavily priced, that the greatest opportunity in the world is to start a business. Starting a business requires sweat equity. If you need to borrow money, you can borrow very cheaply. But the point being is that your return on equity is much higher. Pension funds are struggling to make 7.5%. Even if you look at the hedge fund universe, single-digit returns right now. If you build a business, you can make 20, 30, 40, 50, 100% a year returns by building just a simple business. So I think that's a very good thing for the world as the shift goes away from the financialization of the world economy back into really building businesses again.
That's definitely some contrarian strategies there. During the Great Depression after 1929, a lot of millionaires were made. A lot of people started businesses like Walt Disney when everyone was skeptical that they could actually succeed. So to add to your points there, bringing up gold and the dollar, that sounds to me like a barbell strategy where, you have like the dollar, holding US dollars and holding physical metals are pretty much two good sources of liquidity in a potentially liquidity starved markets and banks and things like that. And, for other bull markets, I think with politicians trying to force in the United States the minimum wage higher and such low interest rates, Raul, I think it's going to move because capital is so cheap for a lot of corporations now. They can borrow so cheaply. I think there's going to be the unintended consequence that these politicians and unions have done with trying to force wages higher. They're going to force a lot of investment into robotics and automation that would not have been made because of higher manipulated wages and lower interest rates.
Yeah, I think that makes sense. I can see the technology space. I've just spent some time in Silicon Valley. There's a lot of rubbish there, but there's a lot of incredible things being done. Again, people are building businesses. There's a little too little focus on actually generating revenue. But when people start figuring out how to generate revenue, that's not just based on advertising, that seems to be most people's model, then I think there's some huge opportunities still to come out of a lot of that. Robotics is one of them, artificial intelligence being another. I also think if you just think of the problem the pension fund industry is in, I know we talked about REITs being particularly expensive, but I don't see any reason why you don't buy every dip on REITs until yields get to the same as government bonds, because the pension system has to keep buying it. And there's trillions and trillions or tens of trillions of dollars in the pension system that needs yield so people can retire. And with all the baby boomers retiring, the stampede of yield will not stop.
Yeah, and about Iran, have you spoken with Jim Rogers about Iran? Because that sounds like the type of investment that Jim Rogers in the past would have done. I know he was talking, I think, about going to Myanmar, but they wouldn't allow U.S. citizens to invest there. He wanted to be one of the first Americans to actually invest there. That sounds like something that Jim Rogers would have done over the course of his career in terms of finding a country that was opening up their markets.
Yeah, I mean, Grant just interviewed Jim Rogers for Real Vision last week. It's the second time we've had him on. So I've no idea whether Iran came up, but I actually started getting involved in Iran 5 years ago, pre-sanctions, and 5, 6 years ago. And I met all sorts of interesting characters there on a bus in Iran. We were going around with a brokerage firm to look at the opportunities, and people have gone out and bought insurance businesses. The second largest insurance business in Iran, a friend of mine ended up buying for a PE of 1 and a dividend yield of 18%. I mean, the opportunities were ridiculous and still are.
Sounds pretty amazing, but that's the type of effort that's required in due diligence in order to outperform markets.
Jason, that's a really key thing, Jason, is people forget after this kind of lazy bull market of the last 20 odd years, is people forget that to make money, you need to work hard. And a lot of it is doing your homework, and it's not easy to buy shares in these countries, and it's not easy to do things, and there's no ETF on it, but that's what makes the reward better. And so, people will learn that again. And it's actually a very engaging, enjoyable process. You read it all the time from Jim Rogers. If you read his investment biker book, how he went around the world to various countries and thought, I need to open a brokerage account in that country and buy some shares and think about that. And, that's the way you really build money. You don't build money by doing easy things.
Yeah, I completely agree. The economy got financialized starting in the 70s, really, in the United States, and then it spread all over Europe and the rest of the world. But before that, Wall Street and finance, at least for a long time, they were mostly focused on helping grow real companies on Main Street. So they would, bring a company to the share markets there, and they would really need the capital so they could build property, plant, and equipment, make the investments, and actually create and grow jobs. And it seems there's been a huge dislocation of that between the real economy and financialization of markets for a very long time.
Yeah, exactly. And that financialization is the big issue that is getting unwound over time. And in the end, the world will be a much better place for it.
Yeah, I completely agree. We have some young listeners out there who are starting to learn about economics and finance. What books do you think they should read? What skills do you think they should have so they can build themselves maybe a business or a career going forward in the stuff that we described about the global economy, how difficult it's going to be?
I think that once you understand a simple thing is that the business cycle is still prevalent now, whether that's in the Austrian economics terms or in whatever terms. But you realize that economies go up and down and they don't stay stable, which is why all economists tend to get their forecasts wrong, because they assume a trend rate of growth. So the simple way to understand that the best is read Mania's Panics and Crashes by Kindleberger. And you realize that this pattern of boom and bust is prevalent through all of human time. And once you understand that, you have a much better grasp of economies. That means you don't get over your ski tips in risk when things are good, and you don't get ludicrously bearish when things get bad. You start to think, you understand that there's a business cycle. And I think that is probably the key thing for anybody to learn about economics. I don't personally like much of the economics textbooks because I think both the Keynesianist and the monetarist answers to everything are all wrong. They're all built on status quo, and they use the famous term ceteris paribus, all things remaining equal, meaning that this thing doesn't work in the real world. And that's what we're proving right now by central bank actions. They've kind of thrown Keynesianism and monetarism together and hoped it'll stick, and it's not, because they don't work in extremis. So I think, some understanding of the Austrian school, and I'm not a full adherent to the Austrian school. I just believe in the business cycle and practical economics. And just to understand that, I think that'll put people on a much better foot. Now, whether that's investing in financial markets or just building businesses or just understanding their own personal economy.
Yeah, I think humans unfortunately make a lot of irrational decisions relying on their emotions, and financial markets, there's the efficient market hypothesis. I think for most of the time that's just ridiculous. I mean, markets are the market participant is not cool, calm, and rational and knowing all the news and information. That's just not how markets work. I tend to look at the James Dines view of markets, where markets oscillate between greed and fear.
That's right. I was just thinking of another book, actually, which is The Extraordinary Delusions and Popular Madness of Crowds. That's another one that teaches you the same thing and was written quite some time ago and tells you exactly that, is that it is clearly not an efficient market. It's a behavioral economics market. Once people understand behavioral economics is the way forward, I think we'll make some big breakthroughs. But right now, economic modeling just does not make sense for, human psychology.
I completely agree. Well, Raul, I want to ask you to tell our listeners about Real Vision TV and the types of things you do over there. I've watched some of your free videos. They're absolutely excellent. What do our listeners out there, what do they get if they sign up for the pay version?
Yeah, listen, we have built the world's first video on demand platform for finance. There's nothing like it anywhere in the world. There's no content like it anywhere in the world. What we basically did is we had an ethos, which was to bring truth back to finance. And I talked before about the breakdown of trust between the media and the banks and the average investor back in 2008, 2009. People just didn't know what was going on and they weren't told, and it was wrong. So we thought, you know what, we can build a platform, a media platform, which was kind of naive of us because none of us had a media background, but we could build something where we could ask the world's best investors, the most famous investors you ever heard of, the most successful guys, and sit down with them for an hour or half an hour or 45 minutes and say, right, how do you think about this? What are you investing in right now? And not the 3-minute sound bites of CNBC, but a real in-depth place where you can learn something interesting. And again, it's not about copycatting trades from legendary investors. It's about understanding how they think and they invest, because then you can do your own style. So we do it with legendary investors. We do it with up and coming, very interesting guys who have a very specific knowledge base. We also speak to the top independent analysts, economists, strategists, geopolitical strategists, ex-policymakers. What we're trying to do is create the greatest place in the world for the exchange of financial information. And, you know, we've now got subscribers in over 110 countries worldwide. And, you know, people seem to be pretty fanatical about what we've done. So it makes us very proud indeed. I think currently students get a discounted price. They pay about $120 a year, or they can pay monthly. If not, it's about $364 a year, about 99 cents a day to get Real Vision. And, you know, for 99 cents, it's ludicrously cheap value for what you get. People who have things like CFA accreditation can get continuing education credits from watching it. It's been accredited by most of the big organizations as well. So it's, you know, it's something for everybody in it. And if you can't learn from that, then I don't know where you can.
Yeah, I'm not really a fan of the mainstream financial media anymore. I mean, like when they have people like you on, they give you 2 or 5 minutes to try to get your point across. I can't really learn anything, Raul, from hearing someone like you speak in even 5 minutes or 10 minutes. I need to hear like 20, 30, 40 minutes so you have a chance to expound on your thoughts and go more in depth. And I feel, you know, that's the best way for me to learn new ideas or to challenge my beliefs.
Exactly right. Exactly right. You can't. Life is not about 3-minute sound bites. However, we'd love BuzzFeed to be the way of the world. It's not. You know, as we talked about before, there is no substitute for doing your homework. And so we just present it in a place that make it easy for people to do so. We've also got a free trial, so people can just go and check it out because we don't want to put them under any obligation. So they can go and have a look and see if it's for them. And it's just realvisiontv.com.
Excellent, Raul. Well, I want to thank you for your time, and hopefully you enjoyed this discussion and you'll come back on in the future.
Absolutely, Jason. I think it's really good what you're doing.